How is everyone doing? Welcome back to another episode of The Banker Next Door. I am your host, Dr. Joe Berquist. Today, I wanted to talk to everybody about the July 2024 jobs report, which just came out yesterday and basically just sent ripples through our stock market and through the economy. So let's jump in. I want to share a number of things with everybody today. I want to share this CNBC article. I'm going to share a Wall Street Journal article, and then we're going to look at a little bit of data coming out of the Bureau of Labor Statistics, otherwise known as BLS. And then we're also going to look at the Fred database from the St. Louis Federal Reserve just to show you guys some unemployment numbers, just so we could take a look at this. Now, key points here from the So the CNBC article is called Job Growth Totals 114,000 in July, much less than expected as unemployment rate rises to 4.3%. So non-farm payrolls grew by 114,000 in July, below the downwardly revised 179,000 in June and the Dow Jones estimate for 185,000. The unemployment rate edged higher to 4.3%, its highest since October of 2021, triggering an economic rule on recessions. Healthcare again led, adding 55,000 to the payrolls. Other notable gainers included construction, government, and transportation and warehousing. So let me just a couple things here on this. Now, I had been reporting on jobs data. If you go back to an episode I did a few months ago, I did. I'll should put a link to that in the description below, which was an article from Zero Hedge, which basically said the most ridiculous jobs report of all time. It was the January jobs report from this year, and basically there are a couple of huge things that are happening, and you can see that right here. So the first bullet point: non-farm payrolls were just below. In July, but they were also below the downwardly revised 179,000 in June. This is one of the big problems here. For, I want to say, 15 out of the last 16 out of the last 17 months, every time we get a new jobs indicator, the previous months is revised downward. So if you add all that up for a year and a half, you'll basically see that there are 1 million jobs, again, as per the headline number. There are probably about 700,000 to 1 million jobs that were projected, were created, that weren't created, that never existed. And so you're getting this overinflation on numbers as these reports keep coming out. Now, I believe that the reason why the market reacted the way it did is because they said that they grew it by 114,000. It will not be a shock to anybody if we get the August employment numbers in a month and this gets revised downward to probably, who knows, maybe 60,000, 70,000, something like that jobs, which if you're only generating that few jobs, that's a big problem. Some of the other big things going on in the jobs report. All the jobs that are out there that people are getting, they're part-time jobs. Everybody's getting part-time jobs. People have 2, 3, 4, sometimes part-time jobs to try to make ends meet. The really good paying, what you would call white-collar jobs that are six-figure jobs, those jobs have gone negative. You're losing those jobs every month. And then perhaps the biggest scandal of all is that the jobs are going to foreign-born, meaning illegal citizens, not going to American citizens. That's the biggest scandal in this kind of this whole debacle here. So I believe, and they say the unemployment rate is 4.3%. I don't believe that's the unemployment rate. I don't believe that's ever been the unemployment rate. And I'll show you. I'll prove it to you here in just a second, if you bear with me. But let's continue on down here. So it says that job growth in the U.S. slowed much more than expected during July, and the unemployment rate ticked higher, fueling fears of a broader economic slowdown, the Labor Department reported Friday. Non-farm payrolls grew by just 114,000, down from the downwardly revised 179,000 in June and below the Dow Jones estimate for 185,000. And then you can see here from this graph here, and again, this comes from the Bureau of Labor Statistics. This is the growth of jobs here, and you can see how, job growth has been hanging out. So in other words, where do you want job growth? You want job growth to be, you want us to be kind of in that, 250,000 jobs a month, range. That's kind of the ideal range. If you're over 250,000 jobs a month, that means the economy is really growing. If you're in that kind of 200 to 250,000 jobs a month, you're kind of like, everything's kind of like okay. Like you're you're a little bit better than treading water. But when you start falling below 150,000 in job creation, now you're really, that really starts to signal recession, starts to signal that the economy is really slowing down. And then obviously if you go negative, that's obviously the worst thing. But you could just tell here from the, let's look at the list. So April 108, May 216, June 170, was at 179. And then here we go, 114. But you can see from the chart here that going back to October of last year, I mean, we've had a couple of spurts, but generally this thing is especially if you go back to January of 2023, when we supposedly generated 482,000 jobs, you could see here from the graph that we are definitely trending downwards here. And that tells you that the economy is decelerating. Average hourly earnings, a closely watched inflation barometer, increased 0.2% for the month and 3.6% from a year ago. Both figures were below respective forecasts for 0.3 and 3.7%. So let me ask everybody this. If inflation is running at 2.9%, 3%, 3.2%, if inflation's in that range, but your hourly earnings are going up 3.6%. Are you really getting ahead of inflation there? Not really. Stock market futures added to losses following the report, while Treasury yields plunged. And we're going to take a look at that in a minute. And then we got a chart here, U.S. unemployment rate. Okay, so now let's go on to, now let me look at this. So this is Wall Street Journal, July jobs report, how markets are reacting in 5 charts. So take a look at how various assets are performing after the release of the July jobs report. U.S. stocks, the 10-year Treasury yield, Brent crude, gold, and the U.S. dollar. So you can see here, I mean, markets got clobbered yesterday after, you see here, after the jobs report got announced, and basically everything was down. The NASDAQ got clobbered, S&P, the Dow. So all the markets got clobbered. I think the Dow was down, 700-800 points yesterday, something like that. The 10-year U.S. Treasury yield, I mean, look at that. Fell off a cliff to, basically 3.8. And then it kind of hovered around the day and then finished below that, probably hovering in here at around, 3.7, something like that. But we were over 4%. And, just a couple of days ago, we were just a little over 4%. And then boom, this thing has plunged down, which is good for, residential mortgage rates. I mean, that'll help to bring residential mortgage rates down a little bit. Most actively traded Brent crude oil futures. So this is for oil, and you can see basically oil just plunged down about 76.50, and it kind of came back up a little bit to about 77.50 there. Gold futures, like you can see here, kind of initially went up a little bit, but then later in the day, boom, came plunging down. And then they did make a little bit of a comeback there toward the end of the day, getting back up to about a little over 24.85, maybe something in that range. Dollar index again, boom, off a cliff, came back here. So that's kind of the initial market reaction. Now again, I think the question here is do I believe that the market is reacting because that this was a little less than what was projected? No, I don't think that's why the market is reacting like this. I think the market is reacting to what is inside the jobs report, the deeper numbers that are lurking behind the headline number. I think they're looking at this and they're going, okay, the market is really starting to decelerate. There's a lot of garbage and BS in this jobs report, trying to make things look better than they actually are. And I think that's really what the market is starting to react to. The narrative that we have, like this healthy jobs market is starting to disappear. Okay. So I want to show everybody a couple things here real quick now. So this is from the Bureau of Labor Statistics. This is basically their unemployment, and this is what is called the U3. This is the U3 unemployment. So right now we are hovering at 4.3%. You can see here, this goes back to January of 2020. You see the unemployment rate as per the U3. Keep this in mind. I'm going to show this as saying the U3, we jumped up to about 15%, and then we came all the way back down here. And again, you see this little chart down here. You can see that. So let's just do this year. So January, we were 3.7 and 3.9 and then 3.8 and then 3.9 and now 4, 4.1 and now 4.3. So you can see the unemployment has ticked up over the last 7 months here, going from 3.7 to 4.3. So unemployment is going up. And again, that's what the market is looking at. It's not just 1 month here. It's the trend. They're looking at the trend. They're reacting to the trend. Now, let's take a look at a couple other things here. So this is what I believe to be the real unemployment report. This is what you call the U6, and this is from the Fed, which is the St. Louis Federal Reserve database. So what is this? What does the U6 account for? This accounts for total unemployed plus all persons marginally attached to the labor force plus total employed part-time for economic reasons as a percentage of the civilian labor force, plus all persons marginally attached to the labor force. Like, in other words, you've been out of work for a year looking for a job and you can't find, you had a really nice job making $150,000 a year. You got laid off and now you're looking for that white collar job and you can't find one because white collar jobs are negative. So, so you're marginally attached, or maybe you've taken a couple of part-time jobs to try to, tread water or make ends meet in the meantime. So now let's take a look at this. So if we compare this to the U3 that we just looked at, you can see in 2020, the actual unemployment rate was not 15%. It was 22.9% unemployment. And then we come all the way back down here. But what is it currently at? Oh, wait, look at that. July of 2024, it's 7.8. 7.8. 7.8 is a lot different than 4.3. It's a huge difference. And you can see here, and again, look at this. Let's go back to 2022, 7.2, and then coming down here to about the lowest it got, which was about 6.5, basically. In December of 2022, it got to 6.5, and it's been going up all the way up to 7.8 ever since. That is what the market is reacting to, because that is the real unemployment rate. It is not 4.3%, it's 7.8. And that is what the market is reacting to. And it's looking at this trend going back over basically the last year and a half, and it's seeing the unemployment rate, the actual unemployment rate, rise from 6.5 to 7.8. And it's seeing the number of jobs open dropping way off. And it's basically saying that all the jobs that are being created are part-time jobs being given to foreign-born citizens, whatever, however you want to describe that. And so that's interesting. And so now here's perhaps a more interesting thing here. So this is the labor force participation rate. So we can see here in January of 2020, you can see here, and then even going back to October of 2019, you can see here our labor force participation rate was about 63.3%. And then, of course, after COVID hit, we dropped down to 60.1, and then it's made kind of a steady comeback. And we got up here in November of 2023 to 62.8. And then we kind of come down a little bit, but now we're apparently back up to 62.7. Now, here's the thing. Do I believe that this labor force participation rate at 62.7, first of all, that's not great. That's not a great labor force participation number. I think ideally, we have had in the past, let me see if I can go back to, again, you look at, so here's a 10-year chart, and you look at this and you go back and you can see that we've basically maintained a range of, somewhere in the 62 to 63% range. I think we've pressed up in the past to almost about 64%. And then we've had years where we were probably at 67, 68%, many years ago when things were going really well. That's really where you want your labor force participation rate to be. You want it to be at the 67, 68%. That really tells you that people are really, into the market. Now, who doesn't get counted? Obviously, retirees, kids under the age of 18, minors, they don't get counted into the labor force participation rate. People that are on disability, people that are disabled. If you want some really interesting numbers, look at the number of disabled people and how that has exploded in the last couple of years, and how that figures into these numbers. So, yeah, not gonna go down that road here. Not gonna go down that rabbit hole in this video, but yeah, very interesting stuff to look at if you're ever curious and ever get the time. But again, I think that there are a little bit of games played with this labor force participation rate. Do I really think that this is 62%? Maybe not. It might. The reality is it might be a little less than that. It might be 60 or 61. But anyways, so what do I think this means? I think that this is showing, this is all this is leading again. We're heading toward recessionary territory here. I have been calling this out for 6 months now, saying that I thought that the monthly job reports from the Bureau of Labor Statistics were just chock full of the headline numbers were just all just gaslighting, basically trying to put on a good face that oh, hey, the workforce is great. Look, we're below, we're well below a 5% unemployment rate, and we're generating jobs every month and strong jobs, and everything's fine, nothing to look at here. And you kind of, and again, and you go back to the Federal Reserve, like, well, will the Federal Reserve cut the rates? Well, I say, and I've said, if you look at the headline numbers, where's the justification for them cutting the rates? Do I think they should probably cut the rates? I don't think so, because I'm actually more concerned about inflation than I am about the job market right now. And some people may not get that, but I go back to the 1970s and I go back to what happened when we saw inflation spike. And then, when we saw inflation spike up to, 18, 19%, and we had Paul Volcker had to come in and had to jack the federal funds rate up to 15%. And we had interest rates of 20%, and 22%, rates of interest. And I am highly concerned that you could see that scenario play itself out again. And that's why, like, I am not for the Federal Reserve really reducing interest rates right now, even though we need it, even though because I think that's the direction the economy is heading in. I think the economy is potentially going to tank here in the next 6 months, and that is basically going to force the Fed to get perhaps more aggressive than they may want to in cutting the rates. But we shall see. We shall see what happens. We'll have to look back on this in a few months and see if I was right or if I was way off base. But anyway. That's this video for today. If you like it, please make sure to like, share, and subscribe. Leave your comments down below. I would love to hear people's comments on this. Like, what do they think about this? How do they feel about it? And then make sure to check out some of the other videos I posted up on the channel. And I will be back to everybody again real soon. Thanks a lot.